Well, thank you for everyone for attending. This is Washingtonians for Public Banking's fifth virtual town hall for the year. As I mentioned before, we have these every 2 months as an opportunity to inform our supporters and the general public about information regarding public banking and financial reform. I introduce our speaker, I do want to let people know that there is an upcoming conference. So if some of the information that you find in this lecture intriguing, you might want to attend an upcoming conference put on by the American Monetary Institute. It is a virtual conference, and I'll put in the chat the link. So if people want to continue their education, they can go there. The conference does start this weekend for those who are interested. Now, without further ado, I would like to introduce our speaker for today. We're pleased to have Dr. Ronnie J. Phillips. He received his PhD in Urban Studies from the University of Oklahoma in 1973 and his PhD in Economics from the University of Texas at Austin in 1980. He's a professor emeritus of economics at Colorado State University in Fort Collins, and he has published widely on banking issues, entrepreneurship, public policy, in books, academic journals, newspapers, magazines, and public policy briefs. We are very pleased to have him today to inform us about the Federal Reserve payment system. So without further ado, please take it away, Dr. Phillips.
Okay, thanks. Okay, let me start to share here. I think you have to okay me to share, right? Okay.
There you go. You should have sharing privileges now. Yeah.
Okay, everybody can see the, can you see my key?
Not
Is it
quite.
working?
Might want to try it again.
Whoops. Let's see here. Are you seeing it now? Should be.
No, can't see it, just see you.
Let's see. Do I have to? Well,
looks like you are a co-host, so you should have that.
Oh, okay. Oh, well, maybe it. All right. All right. There's what I need to share, I believe.
Okay.
Kind of changed this. They've changed the app up since okay, you can see it now?
Mm-hmm.
Federal involvement in the payment system. Well, thanks for inviting me, and I'm looking forward to any questions or discussions that you may have. Now, as you may know about the history of banking in the United States, that we started off with from proposals of Alexander Hamilton to have the first bank of the U.S. And this was really a bank that would assume the Revolutionary War debts and pay off those war debts. It would raise money for the new government. It also established a national bank and create a common currency. That lasted until 1811, had a 20-year charter. And then that charter went out. And we know, of course, what happened in 1812 was the War of 1812. And when you have a war, you've got to do some more financing of government spending. So the Second Bank of the United States went into operation in 1816 and lasted until 1836. Now, Andrew Jackson was the president at that time, and Andrew Jackson didn't like banks, and he vetoed the renewal of the charter for the Second Bank of the United States. This resulted in what's called the free banking era. It's not sure that's a real good name, but that's what it was called. Okay, whoops. Okay. If you've been down in Washington, D.C., down near the Treasury, this is at 15th in New York. This was, it's called the Truist Bank now. It was originally National Savings and Trust Company. It was built in 1887. Now, they advertise on the side in those nice little, I don't know, metal boxes there, their banking services. You notice they had safe deposit boxes, commercial banking, and interest paid on deposits. These are all from, again, when the bank was started in 1888. This is the one, though, that attracted my attention. foreign and domestic exchange. And I'm guessing that if I went into the bank building and asked them about domestic exchange, there's not any employee that would know what I was talking about. But the point is that after 1836, there were thousands of local currencies in the U.S., and this necessitated a market for domestic exchange. Now, just to give you some examples, there's National Banknote from Denver, San Francisco Clearinghouse, San Francisco Gold Bank, Canal Bank, Manual Labor Bank, plenty of, these are all different currencies, some state, some federal, and some that were just local banks. So what you had develop after 1836, and it really got started in the 1840s, you had a nationwide system of clearinghouses with member banks. Now, this system is uniquely American because remember, we didn't have interstate banking. In fact, most states didn't even allow a branching. So you had unit banking throughout the country. So what you had developed, again, in the 1840s throughout the entire 19th century, is a system of local banks. Those local banks could have correspondence banks, but then there were also in the major cities clearinghouses, which would clear the banknotes and deposits of member institutions. Now, if you ask yourself at this time, how do you make a payment? If you're in New York or New England, you want to make a payment to cotton producers in Texas. How do you do it? You ship gold or silver. You can have a bank account in Texas and write a check on a bank in Texas. You can have banknotes issued from a state chartered Texas bank. You could purchase a draft on a New York bank. Now, this is really the interesting part because these drafts on a New York bank, this is what the balance sheet would look like. So this is a New York bank. These drafts, you can really think of them as their cashier's checks. But the cashier check, what's different about it now in the 19th century is it's first of all redeemable in gold, and its value depends upon the supply and demand of those drafts in any particular region. So you can have these drafts issued, and they can be used as money throughout the entire country. Now, this is an example of one of those drafts, and I had to search some coin stores to find these things because most people say, well, this looks like some sort of check. But you'll notice it says 3 days after sight, paid to the order of ourselves, $36 and $5,100. Value received and charged the same to account of James B. Vanderdicken, but you'll notice with current rate of exchange on New York. And this is what is, again, tells you that this is something else. This is not a check, okay? This is a draft or a cashier's check that is being used for a transaction, but it's done through a bank in New York. Now, the other thing is, in addition to the exchange rates, which I'm going to show you in a moment, there was also a remittance fee. You'll notice here, although the check is made out to $36.50, the charge on it, written there in pencil, is $36.65. That tells you that the remittance charge for clearing this, that the local bank charged, was 15 cents. Okay, so it was a fixed. So what was unique about these? There's a fixed remittance fee paid to the local bank, but they're redeemed at the market rate. Okay, and these have to be redeemable in gold at this time. Okay, now this is just another example, and you can see it's a similar thing, but this happens to be a draft drawn on Chicago. It's paid to the Merchants National Bank in Helena, Montana, and you can see again the signatures. If you know, again, if you use cashier's checks, that's kind of what this is, except there's a charge for clearing it, and it also has to be with the current rate of exchange. So again, it's $450.50 with the current rate of exchange. Okay. And so this would be a draft drawn on Chicago Bank. So you had New York banks, Chicago banks, in the major cities, banks could do these drafts. So that's why you end up with thousands of currencies or thousands of drafts in the United States. So it was a pretty complicated system. Now, just to show you what these look like, and there was a lot of study of these drafts, and this is a Chicago price of $1,000 draft on a New York bank. This is all from the National Monetary Commission. And you can see it fluctuated quite a bit, but it's if you look into this, it's really a lot of it is seasonal variations. You know, when you produced cotton in Texas and sold it to New York, there's going to be a supply and demand of those drafts in Texas. And other times, you know, Texas is going to be buying clothes from New York. And so that's really what accounts for a lot of this. But you'll notice there in around 1907, there's this big spike. Okay. And of course, what happened in 1907, it was the panic of 1907. Now, the other thing that people forget about is, you know, we're used to instantaneous communication these days, but remember at this time after the 1860s, we had the telegraph. Okay, so the telegraph, and these rates would be published. You had with a city like San Francisco, you would have regular through the mail rates and telegraphic rates. If you know something about San Francisco, you know they had a fire in April of 1906, and so nothing, of course, happened in that period of time. Now, the panic of October, November 1907, that panic does begin in New York. You'll notice that though at some point the regular rates, the through the mail rates stop, they can still do telegraphic rates. So it's really quite interesting. It's quite a bit of information you get about the region, what's happening in the different regions. So you still could have telegraphic transfers, payments being made again via the telegraph. And I have more of this. This is, you know, during the panic of 1907, the clearinghouse has also issued currency. And you'll notice this is a San Francisco clearinghouse certificate for $1 in panic of 1907. And this happened throughout clearinghouses all over the country. Okay, that was from November 1907. Now, the other thing about this is it varied with the cities. Now, this is done in terms of a premium or a discount on, so the zero represents par value of a New York draft in 3 different cities. Okay, now you notice they more or less go together except for when? Of course, the panic of 1907. And what's interesting here is a New York draft in St. Louis, you would have to pay $106 for. Again, this is basically the gold price. Chicago, it's 1,001. In New Orleans, it's 999. Now, what does that tell you? Well, you know, you'd think, well, gee, if there was some arbitrage there, that you could go down and buy a New York draft in New Orleans and go sell it in St. Louis, and you make $7. Okay, so it's a really interesting market of, you know, what was going on here. And you can speculate, why is there a higher price for New York drafts in St. Louis versus Chicago and New Orleans? You know, other things remaining the same, it could be that really means the banks are weaker. So what I would say from this, possibly, and again, you'd have to really look at the story to see what was happening in these cities during the panic of 1907, but it would imply that the St. Louis banks were overall weaker than the New Orleans banks. Okay. Now, of course, comes again. This time, the Civil War, and we passed the National Banking Act. Now, what was the purpose of the National Banking Act? Well, it was partly the same purposes as the first and second banks of the United States. Okay. So you wanted to get a common currency throughout the entire country. And then, of course, have par clearance, have $5 in New York be the same as $5 in San Francisco. Again, these would be redeemable in gold. And of course, it helped finance the Civil War for the North. And very importantly, it created a national chartering agency for banks, and that would be the Office of the Comptroller of the Currency. Okay. Now, if you look at what happened to the movement of domestic exchange rates over the period of time, roughly 1843 on, you'll notice that they steadily decline. Well, what would explain that? Well, one of the things would, of course, be improvements in transportation technology with the trains and so on, but also, of course, with the telegraph. Okay. And you can see it, they steadily declined, where this again would be premiums on basically $1,000 New York draft. Okay. This is from an article by Garbad and Silver. But what you should note is when the Fed, we know, began operation in 1914, this did not end domestic exchange rates. Okay. Basically, what the Federal Reserve is it set up a clearinghouse system with the 12 banks, and it was these 12 federally chartered banks in competition with what had already existed for the last 70 years, which was the clearinghouse set up by the private sector. So you've got competition between the private sector and this new government institution. Well, not surprisingly, if you've been using one system for 70 years, and the federal government tries to change it, it didn't really go over that well. So what did the government do through the Federal Reserve? They set up a leased wire telegraph system, and what the Federal Reserve was then able to do is to offer drafts that could be cleared at par with no remittance fee throughout the country. Okay, so you're looking at now a cotton producer in Texas. What are your choices? Well, you can use through the Federal Reserve System, the Federal Reserve notes, the Federal Reserve regional banks, and so on, and the member banks, and there would be no remittance fee, and they would be at par. So, in doing this is the big intervention of the government into the payment system. So, previously, at least for 70 years almost, we'd had the private sector operated, and now, shortly thereafter, the Feds, beginning in 1919, put all the other clearinghouses out of business. Why? Because the other ones had exchange rates and had remittance fees. The Fed, at par, no remittance fee. This lasted quite a while. Some of you may remember when your local bank used to mail your checks back to you every month. Well, that's because up until 1980, you had basically a free checking for banks. They could clear all those checks. Remember, the Federal Reserve had their own airplanes and all this other stuff. It's quite an interesting story. But beginning in 1919, that ends that. Was very lucky. At the time when the Federal Reserve was trying to get banks to join the Federal Reserve System, the Public Bank of North Dakota applies to join the Federal Reserve System. They were approved. They opened for business July 28th, 1919. So what I would say here is great timing for the Bank of North Dakota. At a time when the Fed wanted banks to get into the Federal Reserve System, they were opening for business, and they were, of course, allowed into the Federal Reserve System. Now, the Federal Reserve operates this check clearing, wire transfer, and automated clearinghouse payment system. When they started this, like I say, in 1918, they were trying to get banks to do this, to join their system. So It was very easy. Okay. In 1917, they opened it up to non-member banks. So banks that weren't members of the Federal Reserve could still get access to the check clearing, the wire transfer, the Fed wire, and the automated clearinghouse. Okay. In 1980 is when they expanded it to thrifts and credit unions. Okay. The Fed had to begin charging for some of its services. And that's when the free checks and all that stuff ended. Now, in 1998, the Fed started using the term master accounts. And that master account is just letting a bank have access to check clearing, wire transfer, and automated payments, clearinghouse payment system. Okay, so they start using this this term. There's an excellent article. I'll say more about this, but Julie Hill is the person who is a lawyer who has written a lot on this, and I'll say more about her. But after 1998, especially in the 21st century, we had some very interesting bank applications to try to get a Fed master account, to try to get access to the Fed payment system. You had a cannabis credit union in Colorado, and the Kansas City Fed turned them down. Okay. Now, again, there's a lot to this story, and they send you some letter, but they can basically say to a cannabis credit union, well, marijuana is illegal, so you can't have one. Up in Connecticut, there's a bank called the Narrow Bank, and what it basically does is it wanted to operate the payment system for large accounts for large banks, and it would not make any loans. It would just hold cash and short-term government securities as its asset, and it would facilitate large financial transactions between large banks using, again, a system if they had been allowed to get into the Federal Reserve System. The New York Fed turned them down. Now, we get into the cryptocurrency. There's a bank it's just 40 miles north of where I live, called Custodia Bank. Custodia Bank wants to basically be a custody bank for cryptocurrencies, Bitcoin, and so on. But when they do that, when you make your deposits of Bitcoin, they're going to back these 100% by safe assets, either cash or short-term government securities. They were also turned down because it's cryptocurrency, it's Bitcoin, So the Kansas City Fed turns them down, and this has been ongoing for several years. Now, you also had around 2018 the American Samoa's Public Bank, San Francisco Fed. They got approved. Okay. Now, why is that? Well, you can read Andrew Van Dam's story about that, but there was some pretty good connections there for the American Samoa Bank to be able to get that. So the American Samoa Public Bank got access to the Federal Reserve payment system. Another case was the FinTech Non-Depository Trust in Colorado. They lost their access, so it was taken away. So only American Samoa's Public Bank was approved. Well, what's happening now? Well, all these sort of normal or non-regular institutions getting turned down, it's led to what's being referred to as the debanking debate. And it's basically why is the Federal Reserve, why are the Federal Reserve banks turning down these banks for access to the Federal Reserve payment system? Well, again, Julie Hill has a great article on this, saying that really what needs to happen is the banks need to first of all, or the Federal Reserve banks, they shouldn't turn down the banks just because they're marijuana banks. They shouldn't turn them down because they're public banks. They shouldn't turn them down because they don't have FDIC insurance. This could be another reason. So, what she has suggested is that the regulators, the Federal Reserve Banks, be required to provide more information about when they make these decisions. This has basically been a secret. The banks, Kansas City Fed, San Francisco Fed, New York Fed, they turn them down, and they don't really give reasons other than saying, well, you don't have federal deposit insurance, so we can't do it, and stuff like that. So, this brings us to the Genius Act. Okay, now, what is the Genius Act? Well, a lot of places, and again, Wyoming, just north of me, is the one getting into this. They want to issue these stable coins. Now, what is a stable coin? It's going to be basically a digital asset that is backed basically by safe assets, which would again mean cash or short-term government securities. There's already lots of stable coins out there. And the thing is about the stable coin, it can be issued by anybody. This is not a bank thing. This can be issued, in fact, Wyoming and I think other states are talking about issuing their own stable coin. Now, this could be an idea as an alternative even to a public bank. The state could issue a stable coin, and it would be backed by presumably safe assets, which could be the revenues of the state. So, so this whole thing is the stable coins, and it's really come about. There's Tether, and there's also Circle. Circle has applied, which issues the USDC, US dollar coin, or whatever they're calling it now. They've applied for an OCC trust charter because, again, Circle, these stable coins, this is the payment system. They're not going to be making any loans. Okay, there's no loans here. This is just operating the payments system. You know, we're already all familiar with PayPal and Walmart and Apple Pay and Google Pay and all those things. Well, this law now allows basically anybody to, it could be a firm, it could be a state, it doesn't have to be a bank, to issue a stable coin. It's a digital asset. Now, I want you to note here in this part B here says that is not a national currency. This is kind of curious because if you go back to those national banknotes issued during the Civil War, what does it say at the top? National currency. This is referring and saying that these, even though these are going to be backed just like national banknotes, they're not going to be national banknotes. Kind of an interesting thing. You would have thought maybe those laws of national currency had no relevance, but they saw the need to put this in. So, and here's the point. Public banks need access to a Federal Reserve master account. If the Federal Reserve is required to explicitly state how you get an account, this opens the door for other financial institutions. The stablecoin issuers do not need FDIC insurance, and neither does a public bank. And if they're directed by Congress to not consider reputation or other types of things in these master's accounts, this should open the door for the master accounts for public banks, cannabis banks, and anything else. So this will be very interesting to follow. And again, I want to mention a key person here is Julie Hill. Julie was at University of Alabama, and about a year ago, she became dean of the law school at the University of Wyoming. And there is a big cryptocurrency center at the University of Wyoming, and so they're wanting to be a big player in this. So you're getting the legal team and then also having the Custodia Bank. So that's the end of my presentation. I'll be happy to take any questions that you might have.
Oh, thank you. Thank you, Professor Phillips. We really appreciate it. It was very informative on the history of the Federal Reserve and about these upcoming new relations with our currency and stablecoin. So the floor is open to any questions that anyone has on the presentation. We did have Joel did put something in chat at the beginning of the presentation before everything got in the way. So if Joel, if you did want to elaborate your discussion on chat, feel free to do so.
Okay. I don't hear Joel. Oh, I
Joel.
think he's still muted. Oh, okay. All right.
No, he's not muted.
Yes. Okay, I'm not hearing.
Yeah, I think his thing, it looks like his screen froze up. So maybe he's having some technical issues.
Oh, okay.
Yeah. But the floor is open to anybody who has any other questions.
Well, my question is do you think this increases the opportunities for public banks to get into the Federal Reserve System? And what do you think about this idea about Washington State issuing a stablecoin as an alternative trying to get a state charter?
If you want to speak, please just raise your hand function just so we're not talking over each other. Oh, I do have a hand raised. Go ahead, Joe.
Well, Ronnie, you took the words right out of my mouth. That's what I wanted to ask you. I think public banking is an enormously good thing. I keep hoping that there's more success in all the different applications and so forth. How will this facilitate public banking?
Well,
If this, like the Wyoming case you mentioned, if that is accepted. Thank you.
Well, two things. One is just like, the American Samoa Bank, what's the story on that? Now, some people may start looking at it and say, well, the guy at the Federal Reserve was a Mormon, and the ones operating the bank and they wanted to do the bank in American Samoa were also Mormons. Was that some connection there? But the thing is, what you really need is for the Fed to explicitly say, here's what you have to do and why. And if that's the case, and they're not able to use things like, not having federal deposit insurance, because public banks and narrow banks don't need federal deposit insurance. So if they have to state this stuff explicitly, and again, this may come from legislation from Congress, or I don't know, Trump might try this through an executive order. I don't know, to say that they have to let these institutions in. Again, and for most of the history of the Federal Reserve, they wanted banks to join. They wanted thrift institutions. They wanted credit unions to join. And then they put a hold on it. And if you stop and think about it, the reason they put a hold on it is because what it does is it threatens the role of banks in the payment system. Okay. And you already know this just from your daily experience. You don't need a bank to make a payment to Walmart or anybody else. And these stable coins are, as a digital asset, can do instantaneous transfers. Even now, even though the banks have improved the when you get a check, when is it going to be? Can you use it is the balance clear? It's stable coins. It's instantaneous between New York and Paris. Okay. And so and it can be any amount. And what's the cost of an electronic transfer? Virtually nothing. These banks or these stablecoin issuers can make these large transfers or small transfers instantaneously for virtually a very small amount. And that's the way they're going to make their profits, is just through those fees. But it'll be a lot less than what banks have to deal with, because banks deal with all, deposit insurance, and they've got all these requirements and so on. all the stable coin issuers have to do, and there have to be some at least state banking supervision. All they have to do is make sure they've got 100% of the safe assets backing whatever liabilities, the stable coins that they create. Like I say, any state can start doing right now. Can start doing this, and states are already looking at it. I know Wyoming is, but I know there are others as well. Maybe Illinois. I'm not sure, but any state can do this. Can issue their own stable coin. All right, that stable coin can be used as it's money. I mean, it's payments. That can be done instantaneously, even in small amounts. And what would it be backed by safe assets? Well, what are the safe assets? Again, for public banks, it's the state revenues, and be pretty safe. All you got to do is look and see what the Bank of North Dakota has done for the last more than 100 years.
Well,
so
thanks for that, Ronnie.
I think it's a real possibility. I think.
Thanks for that answer, and thanks for the fascinating presentation.
Okay.
The floor is open again. Of any other questions? Not seeing any. We have Joe. Joe, go ahead.
Yeah, well, I have lots of questions. So you're establishing the fact that there's this new competitive innovation. This will reverberate, obviously, into the banking system. And I've always personally felt that the private banking system should be more like a utility and not be so profitable, because everybody needs it. It's not like they're going to lose their business. But this will really create a technology competition that could really lower banking costs for everybody and governments. Could it be used by, I know we're about public banking, but could it also be used by, let's say, credit unions?
Yeah, sure.
Who is already kind of, more related, a cousin of public banking. It's a mutual kind of financial institution. And again, would this enable them to compete more and expand their business and so forth?
Yeah, definitely. Again, the whole thing, there's two things. One, stable coins. The other thing is if the Fed has to start explicitly stating why or why not. That cannabis credit union, why did they turn down the cannabis credit union? Well, because marijuana is illegal. But the question is, can they really use that as an excuse? Congress can come in and change that legislation, and then you can start the cannabis credit union. So again, all of these, they're waiting on really on Congress will have to do something. But as you can imagine, what happens when we find out that the payment system can be operated outside of traditional banks? Well, banks are going to lose a whole lot of business. Banks are going to be turned into institutions which only are able to do lending, really. And that may not be such a bad idea. We have institutions who do the payment system, and we have institutions that do lending, and they don't have to be the same institution. By the way, David Ricardo said that in 1824, a famous economist, that banks do two things, and there's no reason they have to be in the same institution. So, and I think that's what we're seeing now with this competition on the payment system. Everybody wants to get in on the payment system. Okay, states can now get in on the payment system with stablecoins.
Money. All the fuckers pay money. They don't.
That's
yeah. Who is this guy?
And again, digital transfers. There's already, like I say, there's already, Circle is doing this, and others. There's a number of stable coins, but you can do small They're doing large transactions, international transactions, especially because it's really, very, very good there, and it makes a lot of sense when you're transferring millions and millions of dollars. You want to do it instantaneously, okay? Especially if it's between countries. So it's going to be a real interesting development, but that's exactly why banks are opposing it. What this technological development is going to do is force banks to make a decision. Do you want to be in the payments business or do you want to be in the lending business? And that will force a real change in the financial system in the United States. So we'll see. And this could happen in the next year or two. Yes, question.
I want them in the same place.
Virginia, do you have a question? Or we're just hearing some chatter in the background?
Oh, okay, yeah, you can have them in the same institution, but the banks, what banks need to do, and I think you'll see banks will issue their own stable coins. Remember a few years ago they had stored value cards and things like that. And banks can do their own stable coins as well. So you can have both of these functions within one institution, but they're really going to be separate. They're also not going to need federal deposit insurance for the payments side, because the payment side, if it's stable coins, they have to use safe assets, which is either cash, basically, holdings at the Federal Reserve, or short-term government securities. This really, of course, if they do this, by the way, increase the demand for U.S. government debt, short-term debt. So it could be another reason they're looking at it. So, yeah, the banks who begin, and you're going to see this, the banks are going to be issuing stable coins, but it's still going to change. Where is their lending coming from? Well, they're going to have to do more like sort of mutual funds in terms of raising, funds to actually make loans. They're not going to be able to do what they do now, which is to use FDIC insured deposits in order to make loans. That's what is being threatened by these technological developments with stable coins.
Thank you. And do we have any other questions? Not seen one. Professor Phillips, I had two questions. I was hoping, or two issues that you touch on. I know with the legislation with the Genius Act, one of the major issues was having especially for more conservative lawmakers, is having some language that would prevent central banks, the Federal Reserve, from issuing their own stable coins. And I'm wondering if you could talk about how this would play into that. And then the other thing, there is a lot of talk about trying to allow, in the public banking movement, there is a lot of discussion about trying to deal with alternative currencies and having states issue their own currency. And this falls with that, with states issuing their own stable coin. But one of the counter arguments is, if we did that, we'd kind of go back to the situation where before the Civil War, where a lot of currencies were really unreliable, and you wouldn't know if you stepped in one state the value of it, and you could have hyperinflation in one state. So what are the dangers you see that if states started to issue their own stable coins?
That's the crucial thing. And you saw this in that exchange rate data where I mentioned about, are some banks better than others? You saw those exchange rates, like St. Louis was 1,006 and Nordians was 999. Is important if you allow these any institution basically to issue a stable coin, is the banking regulation and supervision. You still have to know if they've really got the assets. And of course, what would happen, and it's debatable how often this would occur, because remember, in the 19th century, you had a publication called the Banknote Reporter. Came out at least every week, and it gave data, information on false or counterfeit notes, on failed banks, and so on. And remember, you also had the telegraph. So yes, there can be definite fraud in this, and it depends on how well the states do their regulation, because the primary regulator of these stable coins is going to be the state. So that is definitely, I know a number of writers who have pointed this out. You could go back to what people call wildcat banking. Okay, now this is going to be wildcat, payment system, but that is important, and it has to be the case that those banks are adequately supervised. Now you'll notice though what Circle did. Circle applied to be a trust company through the OCC, a national charter. Now, if you look among banking regulation, the fact that the OCC is the oldest and really the best bank regulator that's a good move. You would have much more faith in Circle's stable coins because they're going to be regulated by the OCC, as opposed, frankly, the Wyoming stable coin. I don't. I'd be a little bit leery of that. So that is going to be an important issue, and there is definitely a danger of all sorts of things. But that's sort of all that stuff is accelerated with the internet, everything else. Now, the other issue, which is again another good point, is what's to keep the central banks from issuing these digital currencies or digital coins. And you'll notice that a lot of legislators have come out and said we want to prohibit. In fact, I think that is in the Genius Act, that something that the Federal Reserve can't do this. Well, we'll see how that's to be resolved, because anything issued by the Federal Reserve or by the Treasury would be legal tender. Okay, so if the Fed were to get in the business of issuing digital currency, it would be legal tender. What does that mean? It means you have to accept it. That could definitely cause problems for the other stablecoin issuers, in exactly the same way that when the Fed got into the payment system with the FedWire and everything else in 1918. Okay, it would be exactly the same thing. So people are trying to already stop that and say the central bank can't do that. Now, that doesn't, even though they can stop the Federal Reserve from doing it, they can't stop other countries from issuing. Japan's central bank, the European central bank could begin to issue stable coins. That might be preferable to private issued stable coins as well. So those things are going to be settled in the future. And by the future, I mean, in the next just 2 or 3 years, because all it takes is some action from Congress, and they could really open this up. And the Genius Act is the big deal to start this off, but there'll have to be other things as well. Do you want to have, wildcat banking come back, or do you want to have a central bank monopoly? We'll find out in the next few years.
Okay, we do have just a few more minutes left if anyone has another question.
Okay.
Okay, go ahead, Joe.
Professor, does a credit union create money, or is it strictly an intermediary?
Well, when you get in this thing, I mean, financial institutions are intermediaries, but as you know, if you go down to your local bank and want to get a loan, then if they approve the loan, the bank can get the funds. So there is a sense under fractional reserve banking in which, yes, the fractional reserve banking system creates money out of nothing. And some people think, well, that's an advantage, but if you do that, then you've got federal deposit insurance, you've got all the regulation, you got everything that goes along with it. So it's not, it's not clear that's really a thing you want to do. I mean, the fraction by ending fraction, if you separate the payments and lending functions, either in different institutions or in one institution, you separate those two things, that ends fractional reserve banking. There's no doubt about it. And would fractional reserve banking continue to exist? Well, you can issue a stable coin and be in the payment system, no deposit insurance, minimum regulation, or you can do a fractional reserve lending and then have all that regulation. Now, I might say, though, again, you talk about small banks versus big banks. It's going to be the big banks that get into these stable coins first. There's no question about it. And it could, in fact, affect small banks. If people quit using your checking account instead of just have an account with Apple or with Walmart or whatever. It can definitely affect your local bank. But then that's when you put in the argument for public banks. So we'll see what happens. I think it's going to be very interesting. The next few years, what happens with the financial system in the United States and other countries too.
The reason I asked about the credit unions was because I'm wondering if there's a backdoor way of uh, getting the advantage of a public bank. Like if the state or city had its own credit union, could it
Oh,
create money? I mean, the what I see about public banking is that basically it's saying we're going to be like the private banks and be able to fund public goods and services that we desperately need. And there's going to be some
well,
fractional reserve banking there as well. Um,
Uh, yeah, I think you could have that, and that maybe we've already got some cities. I spent time in Great Barrington, Massachusetts, and they've already got like a local currency, something like that. You could develop. Credit union could be the one behind having a local currency. I have a little discussion. I talked about the beer standard, how we have a lot of microbreweries in Colorado and probably elsewhere. Why doesn't a microbrewery go into the business of issuing its own money backed by beer? So instead of saying $1, you get one beer. And so you can always use that to get one beer, no matter what happens to any prices in terms of any currencies. So I think, again, the technology with this digital transfer opens up lots of possibilities. But it's going to mean, just like in the 19th century, they had the banknote reporter. You had telegraphic information going about, what's happening in these financial institutions. Today, with the internet, I bet you can find out pretty fast, any scams or anything that's going on there. So, again, it's interesting. There's lots of possibilities, and it's really driven by the technology.
yep.
Okay, well, with
Anything
that,
else?
we are essentially at time. So I want to
Okay.
thank our speaker once again, Professor Ronnie Phillips, for an excellent presentation. And this presentation will be posted on our YouTube channel, like all our presentations. So if you want to watch it again or know someone who might be interested in this topic, you can find it there. Please visit our website at wildforpublicbanking.org, where you can hear more about upcoming events. So I just want to thank our speaker one more time, Ronnie Phillips. Thank you for an excellent presentation.
Okay.
And hopefully I will see all of you in the future.
Well, thank you
Okay.
so much.
Thanks a lot. And I enjoyed it.
All right.
All
Thank
right.
you.
I did too. I'm
Bye-bye.
glad I came. Take care.